Welcome to the Tastytrade platform.
So we can roll our position and just sort of continue to pay that small amount to sort of keep it going. That's fantastic. I mean, if it happens, right?
So we can take a look at on our slide. Today I want to get across the idea that literally you can express any view you like through options. So we're going to have a look at the Tasty platform and also that you can decide the exact week you think a stock is going to move to an exact level. And we'll go through that with an example. You can also use options pricing to work out exactly what expectations the market already has. So it gives you clues as well as to what the move is going to be on, for example, a set of numbers. Okay. So welcome to the Tastytrade platform, which of course is embedded in the IG platform in the UK, Pega. So let's look at the platform. Here we've got Nike is the stock that I'm going to use as the example. So John Donahue came in from Bain and Company.
Yep.
So you put a management consultant in charge of a fashion brand. Mm-hmm. Wow, he destroyed it. Absolutely destroyed the Nike brand. So now we've got a Nike lifer back at the in charge. So Elliot Hill, 25 years in Nike, has come back in to rescue them. Yeah. But that takes time.
Yes, it does.
You know, the problem being every cool person has been wearing Sambas, right?
Yeah.
All the influencers, you know, everybody and yourself have been in Sambas. Nobody's been buying Nikes. It's just become uncool, is what Money Week said, that John Donahue had made Nike uncool. So that doesn't, you know, people in the street don't care that there's a new CEO.
Yeah.
It's going to take him a lot of time to rebuild the strategy, rebuild the company. Now, there's a chance that we hear about that on Thursday night for the first time. But the way that Nike report numbers, they report numbers at 9:15 p.m. And the numbers, Foot Locker says they're terrible. And also China consumption, pretty terrible.
Yeah.
So the chances are the numbers will be bad, but then we might get some kind of strategy update on the conference call, which is an hour later, or we might even get a date that will be an investor strategy day. You know, and that's the first time you'll see the rebirth of Nike.
And yes, and there's a huge opportunity, I think, for the brand because, you know, I think that whereas some of the other brands have gone like fashion, you know, Nike has always been a real sort of athletes brand. And so if they can get the right sort of athletes to partner with, I think there'll be a huge opportunity for them.
Well, you've actually nailed it, because one of the things John Donahue did is the company was split into, football, track and field, training for the gym, tennis, golf. He did away with all of that. He did away with all the expertise in each segment, and he put it into men's, women's, kids.
Yeah. And
that was it. So he literally ripped out the heart of the company. So it'll be interesting to see if Elliot Hill puts that back in. And that could be what we find out. But how do we use options to express that? Well, what we can do is we can, as we know from before, we can buy puts in the near term, or we can pick a level where we might want to buy the stock and we'd be shorting puts. So if we take a look at the platform again, you can see here's all the dates, right? And this is the expiry. You can see how many days until each one expires. Now, luckily, we've got a monthly expiry this week.
Okay.
So we can actually trade Nike when the options expire only 4 days away. So if we had a really strong opinion, then we could trade that one. So let's have a look. So I've just clicked on that.
Yes.
And the stock is currently at 77. And how do we tell that on the system, Pega?
The yellow line that goes straight across.
That's exactly right. That's where the stock is trading. And specifically, the little circle there.
Yes. Okay.
Now, one of the great secrets is up here on the far right-hand side, this is what we expect the stock to move by in dollar terms by the time of expiry. So we already know the options market saying it's going to move $6.
Okay.
So that gives us an idea. If we think that...
And that's in 4 days' time.
That's in 4 days' time.
So the market actually, even though we are expecting to see low results, the market still believes that the share price will move up.
No, that's a very good point. This is talking about moving up or down.
Oh, I see.
6.
So that's the sort of standard deviation, like on either side. It could move within a window of. So is it double that? So it's a window of 12, or is it sort of 3 up, 3 down?
So it's good questions all round. It is $6 up or down.
Okay.
So a total of 12, a window of 12. And that is what is shown by these blue lines in the platform.
I see. Okay.
So that's your expected move, right? So if that's 70, which kind of makes sense, then how do we put forward a view that we don't think it will go much below 70?
So if we think that it won't go much below 70, right?
That's right.
And so then,
or if it does, we're happy to buy them there anyway.
So that's the call option.
No, that's selling a put.
Oh, selling a put. Okay.
Selling a put. So because
we need to have the put already to then be able to sell it.
No, because you can short things. Remember what we did?
Okay. Yes.
Buying things and shorting with a rugby ball back in lesson 2, I think it was.
Yeah.
You can also short options.
Okay.
Right?
Yes.
Now, we went 2 weeks ago, we said, right, buying a put is like buying car insurance.
Yes.
So then shorting a put is like you being the car insurance company.
Yes. Okay.
Right? So what essentially we're doing is we're ensuring Nike share price doesn't drop below that level. But if it does drop below that level, it's then our problem and we get the stock.
Okay. But we don't think it's going to go much below. So we'd be comfortable with that.
I'd be comfortable with that because I want to buy the stock because I think it's literally going to do the Nike swoosh.
Yes.
Right? So essentially we'd be buying stock in this bit here. So even if we get hit on stock and we get stock put upon us, then I want that anyway because I want it to go higher.
And when would you sell a put? So short a put versus buy a call? Because both of them give you the option to buy at a specific price, right? Or get stock at a specific price.
Exactly.
So why would you use one versus the other?
And that's when we have to decide when we think the swoosh happens.
Okay, so it's about timing.
It's all about timing. And that's the great thing about, with trading shares, you can choose, right, I think it's going to go up or I think it's going to go down, or I don't trade at all. With options, we could sell this 70 put on for Friday. Okay, ignore that one just now because that's an existing position I've got. Okay. But we could sell this put here for 49 cents. So yeah, so remember that. Remember, 50 cents, let's say we've sold that for.
Okay.
Okay? Because then we're going to go a bit further out and we're going to say, right, Elliot Hill is going to give a strategy update and he's going to come up with this wonderful strategy, to give Nike some kind of rebirth, and that it's going to take 3 months to get the market excited about that. Okay, so now the 77, we think the numbers are going to be terrible on Thursday. So maybe the stock comes down first of all, but then, as he gives the strategy update, it starts to give more belief.
Yeah.
So what we really want is some strong upside. So then you look on the left-hand side of the platform, Pega, and more like down here. So how much do we think it can go up? Remembering that it's really been disappointing.
So again, can we sort of see the plus or minus in the top right-hand corner,
done.
maybe?
Excellent work. But yeah, just to give you an idea, it's come down all the way from 95
Wow.
with a profit warning, and even further out than that. Look at that, all the way. The first warning was from 120.
Wow.
And then down to 96, and then as low as 70.
And what is the time frame we're looking at here?
So that's from the start of the year, and we can go back as far as the start of 2023, and the stock was trading at 124.
Okay. So we think we can look at sort of the plus or minus, and a strategy helps the share price, but a strategy isn't actually delivering yet.
Not in the numbers.
Yeah. So I would say I don't think that we'll be back at sort of like the highest levels, because I think they won't have actually shipped product out to people and they won't be seeing the revenue.
No.
But I think the market will give them a little bit of a bump for a plan to get there.
And you know how it does that. This is your first test.
Oh.
What happens if you're not seeing the actual profits come through in the numbers? So your earnings per share hasn't changed. It's still $2.60. But the share price starts to go up. So you scratch your head and say, right, the earnings hasn't changed yet, but what is being expanded? What number is going higher?
So it's the confidence, and then...
That's right. The valuation. And valuation is earnings per share.
Yes.
You take the share price and divide it by the earnings per share, and you've got the X factor, which is the PE ratio.
Yes, the PE ratio, the price per earning.
Price.
Yes.
Exactly.
And we were able to sort.
Yeah, and we looked at the bigger range. So the average in America just now is 23 times earnings.
Yes, and what is Nike? Do we know?
Well, so Nike's on about 25 times earnings.
Wow.
But if you really believe that earnings are going to be much higher in 2 years' time, once the strategy has worked, then you can make the multiple higher now because you feel like it's going to come down quicker in the future. Because that earnings out there is going to be, because it's price divided by earnings.
Yeah.
So the price is going to be divided by a much bigger number, and therefore that PE in 2 years' time is going to look lower.
Yes.
So maybe we could take that out to 30 times. The earnings at the moment, are $2.60 a share. So if we go to 30 times earnings, yeah, even that's only $78.
Oh, wow. And it's 77 now.
And that's, pretty much why it is where it is. So you can see that, the earnings are really struggling.
Yeah. And so other people, I guess, must think the same thing we do, that it's going to come back, which is why it's able to hold that slightly higher PE ratio.
That's right. But that gives us a clue that it probably won't go too far. There's no way it's going to get up to 100, for example.
Exactly.
Now, you asked a great question. What's the expected move? The expected move is $8.33.
Okay.
Up in that corner.
From the 77.
From the 77. So you see your blue line there, just above 87.5. So yeah, we if we wanted to buy upside there, then it would be something like going long at 80. So that's buying a call. So I'm clicking on that offer price.
Okay, and that's
$3.95. Yep.
80 for 3 months. And then, that's $3.95 per share.
per option.
Per option.
Yeah, exactly. Yeah,
and each option gives us the ability to buy one share. Is that right?
Well, there is a multiplier, but yeah, it's $3.95 of the share price. You're right.
Okay. Okay.
Or about 5%.
Okay. Yeah.
So you're paying 5% for that. Now, what we can also do is we can say, okay, but we don't think it's going to go above 90.
Right.
In that really short amount of time, because that would be on a crazy PA ratio. So we can sell that one. Now, what does a call give you the right to do in the future, but not the obligation?
It gives you the right to buy it in the future. Correct.
So if you're buying the call at 80, but you're selling a call at 90, what does that mean that if the stock price goes above 90, what have you done?
You can sort of make money on the gap.
That's right. You're buying at 80 and you're selling at 90.
Yes.
Yeah. Excellent.
But it has to happen for you to make money, right?
It has. Yeah. Well, yeah, it has to go through. Exactly. Otherwise, you just won't take up the option.
Yes. So then that's the sort of insurance that you have, like the ability to do it. But if the share price doesn't actually happen, then you don't have to sort of exercise your right. You just wait until you have the next opportunity.
That's exactly right.
Okay.
So how does that all come together then? So we also think it won't go below 70. So we'd sell a 70 in February as well. That all comes together with the following. Right. So we've sold the December put for 50 cents.
Okay.
We've sold a February put at $70 for $1.50.
Okay.
Then we've used that money to buy a call of paying $3.95. And we've sold a call at the 90 level, which we do have another screen so everybody can see that. And that comes to a net payment of 55. Okay, so we'd have to pay 55 cents only to buy the stock at 80 and sell it at 90.
Okay, I was going to say, so have we spent like $7 here? No, we haven't, because they are offset against one another.
Exactly.
Okay, cool.
And that literally is the Nike swoosh.
And actually, we're not spending too much money to do it either.
Less than 1%.
It's like practically, economical. It's
So, and what you do is you take the payoff, the total payoff is $10, and you divide that by the amount that you're paying, which is 50 cents.
Right.
So you're getting a 20 times payoff.
That's fantastic. I mean, if it happens, right? But if people don't start believing in the Nike plan for like 6 months, though, then perhaps we're in a little bit of trouble. So it's like the price.
Because what you then do is you roll it, and you roll the expiries and you do pretty much the same thing, but for another 2 months' time or 3 months' time.
Okay, and then so we can roll our position and just sort of continue to pay that small amount to sort of keep it going.
So there we go. That is a huge lesson, Pega. We've done so much there.
Yes.
And I know that you go back and watch them again and go through and make notes and everything. So yeah, that's definitely one to go back through and watch.